The global oil map just got redrawn in 72 hours. 300 billion barrels, the largest proven reserves on Earth, just shifted from the China-Russia orbit back into American influence. I've been analyzing energy markets for over 15 years, and I can tell you that what happened in Caracas isn't just a political story. It's the most significant restructuring of global oil flows since the 1973 Arab embargo. OPEC's balance of power just shifted. China's energy security just took a massive hit. And the petrodollar system that everyone said was dying just got a second life. Let me show you how Maduro's arrest reshapes every major oil relationship on the planet, because the ripple effects are going to touch gas prices, geopolitical alliances, and investment flows for the next decade. Before I walk through the winners and losers, let me put Venezuela's oil reserves in proper perspective, because most people don't fully grasp how massive this prize really is. Venezuela holds 304 billion barrels of proven oil reserves. That's more than Saudi Arabia, more than Iran, more than Iraq, Kuwait, and the UAE combined. If Venezuela were a company, it would be worth more than Apple, Microsoft, and Amazon put together, just in extractable hydrocarbons. For the past 2 decades, these reserves have been massively underproduced. At its peak in the late 1990s, Venezuela was pumping over 3 million barrels per day. By the time of Maduro's arrest, that number had collapsed to roughly 700,000 barrels daily. Sanctions, mismanagement, underinvestment, and political chaos had turned the world's richest oil nation into a production disaster. But here's what changes everything. That production collapse wasn't geological, it was political. The oil is still there. The infrastructure, while degraded, can be rebuilt. With proper investment, technology, and management, Venezuelan production could return to 2 million barrels per day within 3 years, and potentially 3 million within 5 years. We're talking about adding the equivalent of another Iraq to global oil supply. Now let me walk through how this reshapes every major player in the global oil game, starting with the United States. American refineries, particularly along the Gulf Coast, were specifically designed to process heavy, sour crude oil. This is exactly what Venezuela produces. For decades, these refineries imported Venezuelan oil, and the technical fit was perfect. When that supply was cut off by sanctions, refiners had to scramble for alternatives from Canada, Mexico, and the Middle East, often at higher cost and with suboptimal processing efficiency. With Maduro gone, American oil companies are already positioning for their return. Chevron maintained limited operations in Venezuela even during sanctions, and they'll be first in line to expand. Exxon, which was expelled under Chavez, has been waiting 2 decades for this moment. ConocoPhillips has outstanding arbitration claims that could be settled through new production-sharing agreements. The economic implications for American energy are significant. Cheaper feedstock for Gulf Coast refiners means lower costs passed through to consumers. Increased Venezuelan production means more supply diversity, reducing American dependence on Canadian heavy crude that has become a political flashpoint. And American oil service companies like Halliburton and Schlumberger will see billions in contracts to rebuild Venezuela's petroleum infrastructure. But the bigger strategic implication is about the dollar. Venezuelan oil under Maduro was increasingly priced and sold in yuan, euros, and even cryptocurrency. The new government will almost certainly return to dollar-denominated contracts. Every barrel that shifts back to dollar pricing increases structural demand for American currency, strengthening the very petrodollar system that was supposedly dying. Now let's examine how this devastates China's carefully constructed energy strategy. For 15 years, Beijing has pursued what they call energy security diversification. The logic is simple. China imports over 70% of its oil, and most of it comes through maritime choke points that the American Navy could close during a conflict. The Strait of Hormuz, the Strait of Malacca, the South China Sea, these are all potential blockade points that keep Chinese strategic planners awake at night. Venezuela was supposed to be part of the solution. Tankers could sail across the Pacific directly to Chinese refineries without passing through any American-controlled waterway. The oil could be paid for in yuan, avoiding dollar weaponization. And the supplying government was friendly, ideologically aligned, and deeply indebted to Chinese loans. With Maduro gone, that entire strategy collapses. China has approximately $60 billion in outstanding loans to Venezuela that were being repaid in oil shipments. A new, American-aligned government has no obligation to honor those arrangements, and probably won't. Beijing faces the prospect of losing both its oil supply and its loan repayments simultaneously. The numbers are significant. Venezuela was shipping roughly 500,000 barrels per day to China before the crisis deepened. At current prices, that's approximately $15 billion annually in energy supplies that China now has to source elsewhere. Elsewhere means the Middle East, means Russia, means suppliers that are either further away, more expensive, or both. Even more damaging is what this does to China's long-term strategy. Every alternative supplier that China now relies on more heavily is either closer to American military reach or already under American diplomatic influence. The diversification that Venezuela represented cannot be easily replaced. There is no other major oil producer in the Western Hemisphere that will defy Washington to serve Beijing. Russia's position is equally complicated by Venezuela's regime change. Moscow had invested heavily in Venezuela as a strategic foothold in America's backyard. They provided weapons, military advisors, and diplomatic support. Russian oil companies like Rosneft had significant operations in Venezuelan oil fields. The relationship was about more than money. It was about demonstrating that Russia could project influence into the Western Hemisphere and challenge American regional dominance. That demonstration just failed spectacularly. Russian presence couldn't prevent Maduro's capture. Russian weapons couldn't protect the presidential palace. Russian diplomatic protests couldn't stop the extradition. The message to other countries considering Russian partnership is clear: Moscow cannot protect you from Washington. The economic losses are substantial. Rosneft had billions invested in Venezuelan oil projects that will likely be nationalized or transferred to American companies. Weapons contracts will be canceled. The new government will almost certainly expel Russian military advisors and close whatever intelligence facilities Moscow maintained. But the strategic loss is even greater. Russia has been marketing itself as an alternative security partner for countries seeking independence from American pressure. Venezuela was the showcase for that partnership. Now it's a showcase for its limitations. Saudi Arabia and the Gulf states present a more nuanced picture. Officially, the Saudis have been careful not to celebrate Maduro's downfall publicly. They have their own relationships to manage with China and Russia, and appearing too enthusiastic about American regime change operations could complicate those ties. Unofficially, Riyadh is quietly pleased. Venezuela has long been a problematic OPEC member, often violating production quotas and pushing for policies that conflicted with Saudi interests. A new, American-friendly government in Caracas will likely be more cooperative within OPEC frameworks and more aligned with Saudi positions on pricing and production. More importantly, the Saudis are watching American capabilities and willingness to project power. Mohammed bin Salman has been pursuing an increasingly independent foreign policy, engaging with China, considering BRICS membership, and occasionally defying Washington on oil production. Maduro's fate is a reminder that American patience has limits and American reach remains global. I expect Saudi policy to become marginally more cautious in the near term. Not a dramatic reversal, but a recalibration. The Crown Prince will think twice before crossing red lines that might trigger the kind of response we just saw in Caracas. OPEC as an organization faces a fundamental challenge. Venezuelan production has been essentially offline for years, making it easier for the cartel to manage supply cuts and maintain prices above $70 per barrel. If Venezuelan production returns to 2 or 3 million barrels daily, that's additional supply that OPEC must either accommodate within quotas or compete against in the market. The scenarios are both problematic. If OPEC tries to absorb Venezuelan production into its quota system, other members must cut their own output to maintain price targets. Saudi Arabia, Russia, Iraq, none of them want to pump less just because American companies are ramping up Venezuelan output. The internal tensions could fracture the cartel. If OPEC doesn't accommodate Venezuelan production, we get a price war. New Venezuelan barrels compete directly with existing supply, pushing prices down until marginal producers are forced out of the market. This hurts everyone, including American shale producers who need prices above $50 to remain profitable. My assessment is that we'll see a period of significant price volatility as markets digest Venezuelan uncertainty, followed by a longer-term structural shift toward lower prices as production comes online. $70 oil may become $60 oil within 2 years, with implications for everything from Russian government budgets to electric vehicle adoption rates. European markets face their own recalculation. The European Union has been desperately seeking alternatives to Russian energy since the Ukraine war began. Venezuelan heavy crude isn't a perfect fit for most European refineries, but it's an option that wasn't available under sanctions. Increased Western Hemisphere production reduces overall market tightness and gives European buyers more leverage in negotiations with remaining suppliers. More broadly, Europe benefits from anything that strengthens American global position. European energy security ultimately depends on American military protection of shipping lanes and American diplomatic pressure on adversarial suppliers. A demonstration that America can and will reshape oil markets through decisive action reassures European planners that their ally remains capable. The implications for energy investment are immediate and significant. Major oil companies are already revising their capital allocation plans. Projects in politically risky regions look more attractive when Venezuela demonstrates that regime change can open new opportunities. At the same time, investments in countries that might face similar American intervention look riskier. Private equity and infrastructure funds are positioning for Venezuelan opportunities. Rebuilding the country's oil infrastructure will require tens of billions in investment over the next decade. Pipelines need repair, refineries need modernization, ports need expansion. This is a bonanza for companies with relevant expertise and risk tolerance. Conversely, investment in alternative energy may face headwinds. If Venezuelan production pushes oil prices lower, the economic case for solar, wind, and electric vehicles weakens at the margin. The energy transition doesn't stop, but it might slow if fossil fuels become cheaper than expected. So, what should you understand about this new oil landscape? First, recognize that energy markets are fundamentally political. The technical factors, supply, demand, production costs, they all matter. But a single political event can reshape the entire market structure in ways that dwarf any technical analysis. Second, understand that Venezuela's return to production is not immediate, but is highly probable. It will take years to rebuild infrastructure and ramp up output. But the trajectory is clear. More oil from a Western-aligned government priced in dollars, competing with existing suppliers. Third, watch OPEC cohesion carefully. The cartel has managed to maintain discipline through a decade of challenges. Venezuelan production returning to the market tests that discipline more severely than anything since the shale revolution. How they respond will determine oil prices for the next several years. Fourth, consider the implications for your own energy exposure. If you hold oil stocks, understand that increased Venezuelan supply is likely bearish for prices over the medium term. If you're planning major purchases that depend on energy costs, recognize that volatility is coming before any new equilibrium is established. The capture of Nicolas Maduro didn't just remove one leader from power, it fundamentally altered the structure of global energy markets. 300 billion barrels are shifting from one geopolitical camp to another. Decades of relationships are being unwound, new partnerships are forming, and the price of the commodity that powers industrial civilization is about to be renegotiated. This is what it looks like when the oil map gets redrawn, not through gradual market forces or technological change, but through a single dramatic act of political will. Whatever you think about the ethics of regime change, the consequences for energy markets are undeniable. So tell me this, how quickly do you think Venezuelan production can realistically return to peak levels? Will OPEC manage to maintain discipline, or will we see a price war? And most importantly, does the return of Venezuelan oil to dollar-denominated markets extend the petrodollar system's life by years or decades? Drop your thoughts in the comments because energy traders, policy analysts, and ordinary consumers all have stakes in these questions. The answers will shape everything from your gas prices to your investment returns to the pace of the energy transition. If this analysis helped you understand the energy implications of Venezuela's regime change, make sure you subscribe. I'll be tracking production data, OPEC responses, and price movements as this story develops. The oil map has been redrawn. Now we watch to see what gets built on the new lines.